The job of the Fed and the Treasury are to keep confidence in the dollar. And they need to keep confidence in the dollar in order to keep selling treasuries, in order to keep running these deficits, because it's not stopping. The last thing that the Fed and the Treasury want is to destabilize the Treasury market by having a deflationary event. I mean, if we have a spike in unemployment, we have mass layoffs, the stock market sells off, companies are making less money, they're laying people off, their GDP goes down, and there's just not as much money to buy US Treasuries. That's a problem. Why is that a problem? Well, the problem is because we're running massive deficits. We're running $2 trillion plus deficits, $2 trillion plus deficits annually in a time that we're not even in a recession.
Hey everyone, this episode is sponsored by Polkadot. Polkadot is the largest community DAO empowering 1.3 million DOT holders to shape the future of the network through active participation. With over 500 applications backed by over $6 billion in shared security, Polkadot's adaptable technology powers a diverse ecosystem from DeFi to AI. Join the Polkadot DAO and be part of that transformation. This episode is sponsored by Mantra. The Mantra chain is the purpose-built Layer 1 blockchain designed for tokenized real-world assets and regulated digital assets, offering scalable, high-performance architecture. Positioned as the blockchain for tokenized RWAs, Mantra is onboarding traditional financial institutions into Web3. Join the ongoing OM Gendrop campaign and be part of the future of regulated digital assets today. Welcome back to another episode of On the Margin, and joining me today is James Lavish, managing partner at the Bitcoin Opportunity Fund and the writer at the Informationist newsletter. James, welcome back on the show. I know you're on here about last November, so it's great to have you. What's going on?
It's good to be back. Always good to talk to you and be on your show. I appreciate it.
Yeah, likewise. You know, it's hard to find some people that really live in both worlds of what's going on in Bitcoin and some of the innovation there, but also have the macro fundamental understandings of how those two things interplay. So it's going to be a great conversation. We're recording this the day after the FOMC meeting. We just had the first cut of the rate cutting cycle. They cut by 50 basis points, which surprised many that were expecting 25. It was one of the first times where we went into a meeting in the last at least decade where it's sort of even odds on 25 to 50. So just want to open it up to just get your initial reaction on that FOMC meeting. What were some of the main takeaways and what are some of the main implications on that?
It didn't surprise me, but because if you look at the Fed mandate, so if you pull back all the way up to 50,000 feet, the Fed has two mandates, and that's stable pricing and maximum employment. That's the way they categorize them. And maximum employment, there's no real number that goes around that, but they just look at historical trends and try to keep that unemployment rate low. And so, but the stable pricing is really the key here. And stable pricing is they've defined that as a 2% inflation target rate. Where that comes from, there's a lot of speculation about that, about the expansion of the gold supply back in the 70s to the I believe it was the Australian central bank. In fact, I'm going to say it's either Australia or New Zealand. I can't remember off the top of my head this morning. This is my first call, but they had determined that that's the rate they were going to pin it, the inflation rate to their target. And the Fed, kind of uses that, and they've been using it all along. So even the earlier this year, like back in February, I believe, Powell was on 60 Minutes. And he was asked, why 2% inflation? And he gave some word salad answer that had nothing to do with the inflation rate. But it had more to do with the target, the terminal rate of the treasuries. So, and the reason he didn't have a real answer for that, and he went into word salad diatribe, was that there is no reason. There's no reason for a 2% inflation except for one. And that reason is because they need expansion of the money supply. And why do they need expansion of the money supply? They need expansion of the money supply because of the expansion of the debt. And if you expand debt, then you need nominal productivity to go higher in order to pay down that debt in the future with cheaper dollars. It's pretty simple. Now, getting back to the Fed and their meeting. So over the course of the last year and a half, we've seen inflation come down from 9% down to about 2.5%, somewhere between 2.5% to 3%. And those are the numbers that they use. They're I guess not highly manipulated would be aggressive, but their
methodology is
the methodology
there's
is
some issues
adjusted.
with it.
They do adjust the methodology to make it look good, in my opinion. And the way they do that is moving things out of baskets and in out of they choose which goods to track according to the period. But anyways, so the point of this is that the inflation has been stuck well above 2%, 2.5% to 3% for a number of months now, going into earlier this year. And so you wonder, well, why is the Fed ready to lower rates all of a sudden if inflation is still above their 2% target? It's a good question. The second question is, well, we did see unemployment rise. It rose above. If you look at, there's one indicator that the Fed really likes to look at. It's called the SOM rule, and the SOM rule was created by Claudia Sahm. She was a Fed employee, and she economist, and she came up with this rule after her time there, I believe, or at the end of her time there, and the rule says that if you take the average unemployment rate for the last 3 months and compare it to the lowest point of this cycle of the last year, then if it's more than 50 basis points, more than 0.5% above that lowest rate. So, to put numbers on it, if the lowest unemployment rate was 3.5% and the average the last 3 months jumps over 4%, technically we're in a recession. That means that the unemployment rate is rising fast enough that you are concerned that we're about to have a spike in unemployment. If you look back in time, you can look at charts of unemployment versus recessions, and every single recession, unemployment just spikes right into it. And so, and it happens right after it crests that 0.5%. Okay. So now you're thinking, well, maybe, oh God, this means we're going to go into recession. We tripped the SOM rule, 2 readings ago, and it looks like we're going to be spiking right into recession. We better lower rates. Is it panic time? And the answer is no. There's a lot going on here. So typically, and we heard what Powell said 2 meetings ago. So to lead up to this meeting, you have to think about 2 meetings ago, and he said that the dual mandate has come back better into balance, meaning that they're doing well with the inflation battle. They've gotten inflation down below 3%. It's going towards 2% in his words. I think it's kind of stuck at 2.5%, but we'll talk about that in a second. But the second one is he saw rising unemployment and he's concerned about that. So now they turn their attention to unemployment. So they've had their attention fully focused on inflation. Now they're like, well, now what about unemployment? Let's focus on that. And so going into this meeting, you knew that was kind of on their mind. Trip the SOM rule, and the second unemployment reading was kind of it was a little bit noisy, but it didn't jump, so that was good news. But then going into this meeting and looking at the press release, you can read through the lines and hear what he said in the press conference afterwards. The press conference afterwards, Powell said, "Look, the unemployment rate, it's stable, but the reason we believe that the influx of many millions of immigrants have they've affected that rate, and so when you have 5, 10, 15, 20 million immigrants, who knows how many there really are, somewhere between 10 and 20 million immigrants come into this country, then unemployment will go up."
Because the labor supply goes up.
Yeah, exactly. So, but it's an increase in labor supply rather than a decrease in available jobs. And that's a big deal. Okay, so now you've got this big mess. We've got unemployment it's kind of rising, but some of it is due to the influx of participants, like you said, but inflation's kind of stuck at 2.5%. Why? So, and why would they be lowering rates now? The simple answer is because the last thing that the Fed and the Treasury want is to destabilize the Treasury market by having a deflationary event. I mean, if we have a spike in unemployment, we have mass layoffs, the stock market sells off, companies are making less money, they're laying people off, their GDP goes down, and there's just not as much money to buy US Treasuries. That's a problem. Why is that a problem? Well, the problem is because we're running massive deficits. We're running $2 trillion plus deficits, $2 trillion plus deficits annually in a time that we're not even in a recession. So that is an issue. So go back to, I like to say, just go back to first principles. And everybody likes to talk about all these details about, well, what the Treasury is trying to do and the CBO and their measurements and the quarterly refunding and then the Fed and its mandates. Okay, just stop everything. The job of the Fed and the Treasury are to keep confidence in the dollar. And they need to keep confidence in the dollar in order to keep selling treasuries, in order to keep running these deficits, because it's not stopping. And that's their main first principles mandate. Stable pricing and low unemployment keeps confidence in the dollar, and they can keep issuing treasuries. And that's when you pull back, way back, that's really what you have to be looking at here and get into the mind of Powell. Well, he wants to leave a legacy. He doesn't want inflation to spike, so he held off. He didn't lower rates this summer. He could have in July, but he didn't. Now, is he behind? And that's why he lowered 50 basis points? The answer is no. He just feels like this is the time to start bringing those rates down. He said it yesterday in order to avoid going off that deflationary cliff. I'll stop there because it was a long answer and there's plenty to unpack there, but
there's a lot to unpack, but I really appreciate that framework because totally, like you said, going into this meeting, the economic fundamentals, I wouldn't say they're booming, but they're not necessarily as bad as, there's some people that were arguing that, leaning on ideas like the Somme rule, that we're on the verge of a recession or in a recession. And for those types of people, the 50 basis point cut we saw yesterday was at the very least warranted. Then there's the other side of the argument, which is that we're not in a recession, we're in a bit of a slowdown. And for those people's perspective, the 50 bips makes no sense. But when you start to overlay these, higher level game theory ideas that you've just been explaining, the 50 bips starts to make a bit more sense. So I want to dig in onto the debt servicing side of things, because that is something where people, Powell never talks about this. Anytime there's anything about fiscal, he just completely turns off and does not answer. So it's hard to get much of an answer from them. But you look at the maturity wall, and you look at just the amount of bills that we have floating high around, over 5% right now. And it would make sense to be able to lower rates significantly, to be able to refinance that short-term debt at longer maturities, at longer rates. At lower rates, to be able to just basically have a longer runway for this deficit, issue that you mentioned. Do you attribute that to this 50 basis point cut? Do you feel like that's the big game at play here? It's just something that they can't really talk about?
We have to go back to some of the answers he's given. He does give answers about, he doesn't tell the Treasury what to do, and that's, he doesn't tell them how much to float and whether they should be in short-term T-bills or long-term treasuries. And, that's right. However, he does give some answers that show that he's very concerned about the Treasury market. Well, what do I mean by that? Well, and he uses the QE and QT. Okay, so let's go back to 2008 when you saw the influx of massive QE when we went into the great financial crisis. Quantitative easing, meaning money printing. The Fed literally just prints money and goes into the open market using the bank institutions, the primary dealers, to go into the market and buy treasuries for them and put them on the Fed's balance sheet. And that stabilizes the market. They literally just print money. It's like putting extra money into the monopoly board and then going and buying a bunch of stuff with it just to get keep everything going. And the problem with that is that, that conditions the market, right? So now you go flash forward to 2020 and you saw a massive QE. Okay. We saw massive QE because that drawdown in the market, because we had lockdowns and people freaked out, rightly so, that the economy was going to grind to a halt, rightly so, because it did. And then they poured, somewhere near $6 trillion into the markets by printing money and walking in and buying treasuries. Okay. So he talks about his tools. So in order to, going back to the Fed and why this is important, Powell talks about the two tools he has, and his tools are interest rate targets, which is the Fed funds rate, and that's the overnight rate, and then banks set all their rates off of that rate. That's number one. The second thing is monetary action, which is QE and QT, quantitative easing, which is printing money and buying bonds in the market, or bonds and whatever else, mortgage backs. And then the second thing is QT, which is the second part of that tool, which is quantitative tightening, which is selling those bonds that they have off of their sheets into the market. And that takes money out of the market, right? And we've been doing that for the last couple of years here. And so quantitative easing, meaning the Fed's been either letting their treasuries roll off their balance sheet and not replacing them. So they mature, which means that they then are letting those roll off the balance sheet, or they're out there actively selling some, mostly rolling them off. And that amount is only about $25 billion a month now, because they lowered it earlier this year. It was 60, now it's only 25 a month. That's really nothing. It would take decades to get rid of all that they have in their balance sheet. Okay, so now why does this all matter, and how is Powell interested in the Treasury, and how do we know that? We know that because not at a meeting, not this last meeting or the meeting before, it was about 3 or 4 meetings ago, he was asked about when did they start to get nervous about liquidity. They start to get nervous about liquidity when the bank reserves in total are about 10%, less than 11%, but about 10% of the total GDP. Okay, so if you have total GDP, now if we're looking, you can look at this, and for your listeners, you can look at this on the U.S. debt clock. Every single day they update this, and it updates real time according to the budget and what they're seeing out of the Treasury reporting. But if you look at GDP right now, it's $28.7 trillion annually. There you go, perfectly. So, but right now, if you look at the reserves and banks, so 10% of that is let's call it 2.9 trillion when they start to get nervous. Well, if you look at the bank reserves right now, they're running about 3.3 trillion. So you got about $400 billion before the Fed gets nervous. Why is that? Well, because, and this is for people who haven't paid too much attention to this stuff before, but this is really important. You go back to September 2019, before the pandemic. Okay, we had what was called a repo spike. That meant that the rates that banks were charging each other to borrow dollars against their treasuries spiked. Okay, so why is that important? It's important because banks hold treasuries as reserve and as almost a cash equivalent. But when they need cash, they need to do something with those treasuries. They either can go in the market and dump them, or more likely, because they don't want to take tax implications or whatever, and they want to hold on to those treasuries. What they'll do is they'll lend them overnight to another bank, and then pay that bank a certain interest rate to get some cash that they need for short term that they use for short term needs. In September 2019, you had a few things that happened. So you had the Treasury first came out with their quarterly refunding announcement, the QRA, and announced they were going to need more money than the market expected, meaning they're going to float more treasuries. Okay, that means that the Treasury needs more capital. The Treasury needs more cash. They're going to take more cash to float these treasuries. So you need more cash in the system, more dollars. That's number one. So higher demand for cash right there. Second thing is that corporations were making their annual tax payments going into September, October, and so they were using cash off their balance sheet to make those payments. So they needed more cash. Okay, so there's another demand for cash. And the third thing was overseas with the dollar, the central banks and investors overseas had a lower demand for treasuries because they couldn't afford them as much as they normally could. So those three things put together ended up having, it ground the treasury. Basically, what it did was it spiked the overnight rate, meaning there wasn't enough dollars. There was a dollar shortage, basically. And so when the treasury was going to go out and do their normal, now raised refunding, elevated refunding, they were concerned there wasn't going to be enough dollars out there, and they were going to have a dysfunction in the bond market. Would they have a failed treasury auction? Not likely, but they could have something pretty ugly. And so instead of having that, they turned around and started QE. So if you pull up Fred and Fed assets, you'll see there's a great there. You can see exactly how the Fed has grown their balance sheet through QE through this time over the last number of years. Since 2008, you'll see it really rise up from that. It would be basically zero before that. There you go. Yeah. See, so now you see it spike up in 2008 where that recessionary bar is. Yep. And then it kind of just climbs. And then you see in 2018, they're doing QT. So it had gotten to the top, and then it's going lower. Yeah. So it's going lower right to there. And then all of a sudden it starts going up again. And that is because of the repo spike. And they started QE then. Why? Because the banks didn't have enough reserves. And so now there's a really long answer, but it explains what's going into Powell's mind is when he sees now, if you pull up reserves of depository institutions on the same charts, so you can see here where those reserves are.
Mm-hmm.
And so now the Fed is getting nervous that, those reserves draw down, we're going to have a problem.
Yeah.
That's where they start getting nervous. Okay.
Mm-hmm.
There's a big picture explanation of what is in Powell's mind and why he starts talking about this. The last piece of this is the reverse repo, and we've talked about this a number of times before. I'm not sure that you and I talked about it last time, but if you look at the reverse repo rate or the amount that's in there has dropped all the way down to it's under 300 trillion. 300 billion, right? So now add that to the bank reserves and you get your total reserves. Basically, this is money markets using reverse repo overnight instead of buying T-bills. So they can drain this to zero before they start getting nervous about that 3.3 going to 2.8. These are all the things that are in his mind, and this is what he's looking at when he's talking about the treasury, because these are his tools that he can use on the QT side in order to make sure that when he's doing QT, he's drawing money out of that along with the treasury who's drawing money out of it, issuing T-bills.
Yeah, because when they issue T-bills, that leans more into pulling out of the reverse repo. So it's been this sort of dual action system. And then there's a couple other tools that they've had too, because now we have the standing repo facility, which allows them to just come in instantly without having to be
exactly.
Yeah.
So now you don't have a problem that there's the Fed is there to take your treasuries and give you dollars when you need them, no matter what. And now we have, and it's not just here. It's basically we've got almost a standing repo facility overseas too. With I believe that we have either 11 or 12 open swap lines now. With places in Europe, with Japan, with Australia, and so we have those swap lines open where if they need dollars, they can get them because we need people to be able to get dollars. We learned that the hard way. Okay. So now why is this all so important? to get to your big question, the reason is because we are running massive deficits in the United States, and we're borrowing trillions of dollars annually, and we're adding that to our total debt load. So now our total debt load is 35.4 trillion. You had it on that US debt clock, and so we're running deficits that are about $2 trillion a year. Okay, how does this all work? GDP is our nominal GDP, and that's our productivity of the whole country. And then we're taxing that. So the government doesn't have any revenue. They just take our revenues, right? So we make revenue, they take them from us. And that's in the form of taxes and fees. And so the tax revenue right now is about $4.9 trillion. It would probably be a little bit higher this year along with the spending, but let's just use what the CBO's estimates were this summer. And we'll just use that because it's close enough within a few hundred billions of dollars. Our tax revenues are 4.9 trillion. Our spending is 6.9 trillion. So we're spending 6.9 trillion, which means that we have a deficit of $2 trillion, which is about 7% of GDP. This is it's insane because we're not even in a recession. We're borrowing at a rate that's recessionary at a time we're not in a recession. So this is a problem, and I like to describe it is that if the US government was a company on the New York Stock Exchange, we would describe it as a zombie company. And what do I mean by that? I mean that the company doesn't make enough in earnings to cover its mandatory expenses and its interest on its debt. Mind-blowing, but let's just walk through it. So the mandatory expenses are things like, these are all things that are signed into legislation. They have to pay them, or else it's a default of some sort. So these are obligations that they're legally obliged to meet. So what are those? They're Social Security, Medicare, Medicaid, and a couple of other programs. But that's $4.1 trillion. So if you put that aside, that's 4.1 trillion out of the 4.9. We only have $800 billion left to spend. Well, we spent about $950 billion on defense this year that we know of. It could be more spending that's tucked into other categories. That's money, billions of dollars being sent out to Ukraine and wherever. But let's just call it $950 billion. This is not mandatory, but it's pretty mandatory. I mean, these are long-term defense contracts that they're not going to stop development on. So now you're at over $5 trillion. Let's call it 5.1 trillion. Then that's 5.1 trillion right there. So you're already overspending between your mandatory expenses and your defense. And then you haven't even talked about your interest on your debt, which you absolutely must. You must pay the interest on your debt, or else you default. And if you default, then your bonds get downgraded and your currency hyperdeflates because nobody believes in it anymore, and nobody's going to hold your bonds anymore. Nobody's going to allow you to borrow money from them anymore. And so the interest on our debt is over $1 trillion annually now. Okay, so let's call it the net interest, meaning that they're intergovernment agencies that are borrowing from each other. The net interest is about $900 billion. But you're at $6 trillion of expenses. Then that's before you have any of your discretionary expenses of almost $1 trillion, 900 something billion dollars. So your deficit is now $2 trillion. Well, how do you deal with that? Like, how do you deal with that deficit? You've got three choices. You can either cut spending, which we hear Trump talking about. Cut spending, we're going to cut all these programs. But the reality is, he'll spend money elsewhere. He'll cut spending out of programs that are not productive, things like the Green Energy and Inflation Reduction Act. Absolutely ludicrous how inflationary and non-productive those are. But not even political. I mean, I'm being apolitical. These programs are nonsense. So and then you can either cut expenses, which is political suicide. Neither party will do it. They try to trick each other into doing it. Every time we have the debt ceiling come up, doesn't work. The debt ceiling gets raised and they spend the money. So that's not happening. The second thing you could do is raise taxes. And if you, there's a lot of debate about the Laffer curve and where this actually comes out. But at some point, when you raise taxes above a certain point, it's irrefutable that you start lowering productivity because you disincentivize companies and you strangle them, and so they can't reinvest in productive product lines. They can't invest in research and development. They can't hire more people, and so that productivity falls. So at some point, higher taxes gets you lower productivity and you get to the same spot of total tax revenue. But the problem is now you're on declining productivity curve. And so that's bad. So you'll have lower, lower revenues in the future. And so that doesn't really work. And we've seen that play out in a number of different countries. The third thing you can do is really simple, which is just borrow more money. Just issue more debt, print money in the times that you need to with liquidity crisis like we've done, and just keep issuing more debt, borrowing more money. Here's the issue with that, though. The more you issue debt, the more interest expense you have, the higher your deficits go, the more you need to borrow more money and issue more debt. And that's called the debt spiral. And you can think of it like a single parent who is struggling to pay bills and has 2 or 3 jobs and just can't meet their mandatory expenses of their mortgage or their rent, their gas for their car to get to their job, the food to put on the table for their family, and clothes and whatever. These are mandatory expenses. You can't, you have to feed your children. Obviously you can do whatever you can to meet these expenses. And so you take out a credit card to do that. Well, eventually you're paying interest on that credit card and you max out that credit card and you've got to get another credit card and do it again. And then eventually what you're doing is you're using credit cards to pay off old credit cards. And so you get into what's called the debt spiral. And so it's just this debt spiral you can't get out of, where more debt begets more interest expense, begets more debt, begets higher interest expense. So eventually what happens is that the country that's in a debt spiral, people start losing confidence in that currency. Why? Well, because they know they're printing it. They know that they're expanding the money supply to enable this. So what happens is the currency starts getting impacted. Now, before we get all the comments and everybody goes crazy here, I agree that there's something that's really important here. Even though the U.S. is in a debt spiral, which they are at this point, we are in it. There are ways we could fix it, but it doesn't appear that anybody's willing to do that in D.C. However, the U.S. has a great advantage of being the global reserve asset of the world with the U.S. Treasuries and the global reserve currency with the dollar. And it's really because the dollar that we have the global reserve treasury, the asset of the treasuries, because people buy treasuries to get interest and then turn them into dollars later. So the important thing here is that this is all the United States, as bad as it is the cleanest shirt in a pile of dirty laundry, as my friend Greg Foss likes to say. And he uses some other colorful analogy. But we won't use those here. But the point is that this can take a very long time. There is no way out of it. As another friend of mine, Lynn Alden, likes to say, nothing stops this train. And what does it all mean? So why do we care? Why do we care about all of this? Like, why are we talking about this? What does it matter? Well, it matters because they're spending so much money that they have absolutely no choice, because they're not going to cut expenses. They're not going to raise taxes. They're just going to keep issuing debt. And so it matters because they're going to keep expanding the money supply, which means that they're going to keep instituting inflation. So this all comes full circle to bring this home, to land this plane. This all comes full circle to why is the Fed cutting rates now when inflation is still high? Because they're not concerned about inflation being between 2 and 4%. They're only concerned when inflation runs so high that it looks bad and people lose confidence in the dollar. So they can't have an inflationary spike of 9, 12, 15, 20%. They don't want that. But to have 2 to 4%, that's fine. If they can get away with it, great. Because what that does is it perpetuates this whole system where they continue to issue debt, print dollars, pay off that debt with cheaper dollars in the future, and everybody's happy except the lower demographic who gets left behind.
Yeah, or bondholders.
Yeah, bondholders in essence that will, yeah. I mean, I wouldn't be buying 30-year treasuries here. I just wouldn't.
No.
For a trade, maybe, but very short term. I would not be holding 30-year treasuries for long term here. Why? Because we know that you're going to get a negative real return on that. Inflation is going to be higher than those bonds will yield. How do we know that? Because if you look back, the average expansion of the money supply since 1971 is over 7%. That's a lot different than the reported CPI. And so that's why people feel this. So like, it doesn't feel like my groceries up 2%. It feels like they're up like 20% from last year and 40 or 50% from 2 years ago. And then you see everybody on TikTok showing buy now the same exact things that I bought 2 years ago. And oh my God, my grocery bill's up 50%, 100%. That's not fake. That's the reality. So, and that's because of the expansion of the money supply. They've had a lot of bottlenecks in supply chains. The suppliers are having to pay a lot more for their largest input, which is employment, just to keep up with all of it. And so everything is more expensive. And that's just the reality.
Hey everyone, this episode is sponsored by Polkadot. Out of the 500 protocols, one of them is called Origin Trail, and they're building a verifiable internet for AI, ensuring the provenance and verifiability of data to tackle challenges like bias and misinformation in AI systems. Used by global leaders like the British Standards Institution and the Swiss Federal Railways, Origin Trail is vital in sectors like asset tokenization, healthcare, and the metaverse. Powered by Polkadot, Origin Trail enhances the discoverability of crucial knowledge and secures information in the AI era. Power the verifiable internet with Origin Trail at origintrail.io. This episode is sponsored by Mantra. The Mantra chain, built with the Cosmos SDK, is the blockchain of choice for regulated digital assets, offering compliance-ready modules and cross-chain interoperability. With partnerships like a $500 million tokenization project with the MAG Group, in collaboration with Zanbank in the United Arab Emirates, Mantra is at the forefront of the RWA revolution. Scalable with up to 10,000 transactions per second and secured by a sovereign proof-of-stake validator set, Mantra is designed for both permissionless and regulated applications, making it easier for institutions to enter Web3. Discover more about Mantra's capabilities and how you can participate at mantrachain.io. All right, back to the show. James, that whole framework, there's the vast majority of it I largely agree with. And I find personally, like I went into this meeting yesterday expecting 50. And that's because I adopt this more, I don't want to call it a cynical approach, but it's, respecting the big game that's being played here that you just articulated well. And you can see that because over the last few years, anytime that their back is against the wall, they'll take the softer road. Like in QT, as you mentioned earlier in the show, they never adopted outright selling of bonds. They just let them roll off. If they actually adopted outright selling, that would be proper QT. That would be a lot more painful for the system. But no, they're just going to let them roll off. Right. They're on the same side. There's the Treasury that's issuing more bills. And then yesterday, 50 bips. So taking that, again, we'll just use the placeholder cynical approach. It's kept me on the right side of things in terms of what the Fed does. But when I look at a lot of and you're a traditional finance guy, you ran a hedge fund, you've done the CFA, you've been in that world. I want to ask you this philosophical question of why do you think there's such a disconnect? Because I see these people that keep getting surprised and getting almost angry that the Fed is not taking inflation seriously. Why did we do 50 yesterday? Why not 25? Everything is fine. But when you adopt the framework that you just articulated really well, things make a lot more sense. Why do you think there's this disconnect?
Well, I mean, people are thinking rationally. In a rational world, the Fed ought to be tackling inflation a little bit harder here, and they would be concerned that we're going to have that spike that we saw back in the 1980s. Right? We're going to have a resurgence of inflation, and why wouldn't the Fed just cramp down on this and make sure that we don't have asset inflation? Well, the reason is because asset inflation is good for the Treasury ultimately, because the market going up As long as it doesn't go into a bubble and we have a deflationary crash, the market going up, stair-stepping up is good for them because we are a highly financialized economy in the United States. And so the disconnect is seeing all of this and seeing how we have inflation and why are they not bringing inflation down harder? Well, okay, now let's talk through that. What can the Fed do? Truly, they can raise rates. They can keep raising rates. They could keep raising rates, and it hasn't had the effect that we thought it was going to have. If you think about it, if they're saying that if the neutral rate is closer to somewhere around 3%, meaning that if we get Fed funds back down to 3%, that's not expansionary, and it's not contractionary, right? So it doesn't make the economy contract or expand. It's kind of just level. It just keeps it where it is. If that's where they're trying to get to, if you look back, how much did 5.5% really impact the market? Why did that? If it's over if it's 5.5% is really contractionary, right? Restrictive. If it is the word that we're looking for here, is if 5.5% is really restrictive and they're trying to get back to 3.5%, well, why is inflation stuck at 3.5%? Okay, there's a few reasons. Number one, we have massive spending coming out of Congress, out of DC. That spending is inflationary. They're spending money, they're just creating dollars to spend money, and you can see the money supply is expanding now. You can pull up M2 and it's expanding, but they're pouring money into the economy, and the majority of jobs that have been created over the last 18 months were from the government. They're not private. So that tells you that spending out of the government is keeping the economy going. Is it fake? It's not fake because it's real, real dollars going into the economy and people use those in the service sectors, but it's not as productive. The government isn't spending money that's on productive projects and productive, businesses. That's private industry that's doing that. Those are the Elon Musks and Tesla and all that. Or Ford or Coca-Cola and all. As bad as these companies can be, they're the ones who are NVIDIA. They're productive. They're creating products that people are buying and using, and creating productivity out of it. That's an important distinction. So, but because of that, you see inflation just kind of stick at 2.5% to 3%. Okay, that's one thing. The second reason that means that it's been a headwind for those high interest rates. The second headwind is that it's not really a headwind, but it's just it means that they weren't as effective. Is that we ran zero interest rate policy for a decade and a half. Basically, you had a small period there in 2018, 2017, 2018, 2019, where rates were ticking up. But I mean, it wasn't really restrictive. You had so many people borrowing and locking in low interest rate mortgages, low interest rate lines of credit, companies that issued bonds that were very low interest rate. You're talking about, we're seeing these commercial real estate projects that are collapsing. Well, they're not collapsing all at once because there are a lot of commercial real estate investments that were struck at very low rates. And so you're seeing them kind of roll off, kind of like little dominoes, but there's not like this big domino effect because there's been so much money borrowed at 0% financing and still locked in that 5.5% really didn't do much. So that's why higher for longer was supposed to take care of that. Is like, okay, we just keep higher for longer, and that'll help inflation because it'll force people to refinance at much higher rates. And if we force them to refinance at higher rates, that means that there's lower earnings. That means that productivity comes down a little bit, or people are not making quite as much money, and inflation will calm down. but we haven't seen that because of the zero interest rate policy. ZIRP was going on for so long. So those are two things that are kind of happening here, and that's and that's why.
James, everything we've talked about, why, I know you're a big Bitcoiner. You focus on Bitcoin. You're managing partner of the Bitcoin Opportunity Fund. Why is Bitcoin the solution or the answer to everything we just talked about?
Good question. First of all, Bitcoin is in its adoption phase. We're not there yet. Let's make that clear. I think we will get there sooner than most people think. Probably not as soon as a lot of Bitcoiners. I'm a Bitcoiner too. I mean, like you said, my fund invests only in Bitcoin opportunities, only in Bitcoin centric opportunities. So why do I think it's the solution? Well, right now it's in its adoption phase, and it's painful. It's not quite an infant. It's not quite a toddler, but it's getting out of the phase of massive volatility, and we have to get out of that phase before the true store of value phase comes into play. And what do I mean by that? Well, because Bitcoin is completely decentralized, there's no one person or entity that oversees the issuance of Bitcoin. It's regulated by a mathematical equation that the miners and nodes abide by. And so there will only be 21 million Bitcoin ever created. A lot of those have been lost. We're probably down to 16 and change. So there's only that many Bitcoin that will ever be in the world, as opposed to the US dollar or the Swiss franc or the euro, or we've seen the yen. They can't just create more. That's it. It can be divided. It's almost infinitely divisible with 100 million pennies per Bitcoin, called Satoshis, right? So this is for your listeners who don't understand Bitcoin quite as much as you have, I'm sure, a base that truly understands Bitcoin way better than I do. But why is it important to us and to me? The reason is the decentralized, immutable protocol where things can't be changed. You can't double spend. You can't fake it. You can't create more. That decentralized nature means that you can trust it. It's trustless. It's trustless technology, meaning I can put money in it and trust it will be there, because there are tens of thousands of nodes all over the world that more than that. And if you add all the miners that are making sure that the protocol is effective, that it's run properly. That's one. But because we're in the adoption phase, you have massive volatility still in the protocol. As money tries to come in and out of this protocol, it moves the price greatly. We use the US dollar here. You can look at, the Bitcoin against other currencies, and it's even more volatile. But the volatility is to the upside, which is good. So as it's doing this, it's going up over time. So what do we need? We need more money in the protocol. And I like to look at, total assets in the world, total investable assets in the world. When you add it all up between the $140 trillion of bonds, $140 trillion of stocks, and then you've got your hundreds of trillions of dollars of real estate, your art and collectibles, your M2, just your cash, gold. You add all that up, the investable assets in the world, and you get about $900 trillion. Okay, so if you say Bitcoin's around $1 trillion right now, when Bitcoin becomes it matures into a separate asset class like gold. Okay, so gold is always listed in that asset asset rack because it's an investable asset and people use it as a store of value and a flight to safety. When you see wars going on, you see instability in markets, money floods into gold, which you saw gold rise yesterday. I think that's two reasons, because people are thinking, oh boy, they just lowered rates 50 basis points when inflation's still above their target. We're going to get more inflation, and I want to hold something that's going to keep up with inflation, and gold does that. That gold is a good store of value because you could always buy a good suit with an ounce of gold, and a nice, a well-made suit with an ounce of gold, and you can go back in time and see that over the time, and it still holds true. Okay, so we use that one. So, but whereas Bitcoin is? Well, Bitcoin went up yesterday because, well, a surge in risk assets. It still acts like a risk asset, where when people want to go out on the risk curve, they'll buy Bitcoin because they don't fully understand it yet. And they're not going to be able to use it as a store of value until that volatility comes down, until we get closer to that, the amount of money that is in gold, the market value of gold, right? So Bitcoin has to go up, closer to 2% of the total investable market, the $18 trillion, to get to the value of gold, to be that kind of store of value and be that trustworthy store of value for investors, which it will get to. It's taking time for people to understand it fully. But when we get to about 1% of total investable assets, I think we're about there, because when Bitcoin is trading somewhere between $250,000 to $350,000 per coin, that's going to make it much easier for investors to get in and out of. Number one, without friction of moving the market by trying to get in and out of large amounts, large quantities of it. That's one thing. The second thing is, with institutions coming into the market with the ETFs, it's really important to understand that there's a few things going on with institutions. Once they really do truly understand Bitcoin and they do their work and they understand why it's different, they're going to want to allocate to it as a separate asset. And when they do that, they're going to allocate 1, 2, 3% of a portfolio to it, maybe as much as 5% in some portfolios. And so they're just going to buy what they need in the market and just go along with the market. They're not going to be as price sensitive as you and I would be.
Yeah. Yeah.
However, they get to that percentage of their portfolio, and then they rebalance. So if Bitcoin goes way up, they're going to sell a little bit to get that. If Bitcoin goes way up in in relation to their overall portfolio, they're going to rebalance it to get it to the right percentage. And if it goes down, they're going to buy more and rebalance to get to the right percentage. And so they're just going to continuously rebalance, and that will help dampen the volatility over time. And that's where it gets to that true store of value, and which is where we're headed, in my opinion. And when it gets there, and we continue with this debt spiral, we continue with the deflation, the devalue of the dollar, that confidence of holding dollars continues to go down, holding treasuries and knowing that, oh man, I don't want to have a 30-year treasury. I want to hold something that will really give me my, store my value, that hold against inflation. Then you'll start seeing investment firms and investors allocate out of long-term bond portfolios and into Bitcoin. And that's a ways off. But when they do that, then the whole game has changed. And that's where Michael Saylor's, all your models are broken comes into play. And Bitcoin becomes the ultimate store of value for investors.
What's up, everybody? Just want to take a second out of the show to talk about the next major Blockworks conference that's happening. Permissionless 3 is a leading crypto conference, and it's going to be happening in Salt Lake City this year from October 9th to 11th. There's going to be some major legendary speakers there from the likes of Balaji, Chris Dixon, and macro veterans like Dan Tafiaro will also be there. Not only that, but we're also going to be doing a live recording of the weekly roundup on the Margin Guys Emporium edition. So you can come meet myself and Tyler and Quinn, and even Mike will be there. If you're interested, we have a discount code, Margin10. Use that and you'll get 10% off as well. So I hope to see you there and that we can catch up. All right, back to the show. Yeah, I think that's a really awesome articulation of the proposition for individuals and corporations. The last thing I want to talk about as we wrap up here is the proposition for sovereigns, for global sovereigns. Looking at countries like the US, and there's some belief that Bitcoin could be the capital R reserve currency. There's other belief about it being a strategic reserve asset. And I think there's an important nuance there. highly convinced of the strategic reserve asset component, less convinced of capital R reserve currency. Where do you stand on that? And what do you think is the use case for global sovereigns?
Well, I mean, look, the use case in my opinion, there's a tremendous use case for global sovereigns. I mean, why wouldn't you just be printing money and buying Bitcoin at this point in order to have it on your balance sheet and point to, along with gold, to say that you do have assets on your balance sheet that are worth something, not just treasuries, right? So, or not just, gilts, or not just Japanese government bonds, JGBs. You'd want something that you can point to that's tangible, that has value in the marketplace. I believe that we're not there. We talk about adding it as a strategic asset. We could do that. Trump may find a way to do that. I believe it requires certain legislation in order to get that done. It does. But the question is when does this really happen? Well, you're going to see a lot of currencies and a lot of bonds around the world start to fail. And I don't think it's going to happen next year or two, but over the next 10, 25 years, you're going to start seeing these things failing because they're just printing money endlessly. They're just borrowing money endlessly. They're borrowing from the future and they're not creating something that's productive, which is like energy assets, for instance. So you can see in a place like that, place that's done it well is France. They've invested in nuclear energy, and you could see the productivity per citizen skyrocket. The exact opposite is happening in Germany, right? So productivity per citizen is tumbling, and it's because they're shutting down their nuclear plants. They're having to buy energy from Russia at high cost. They don't have the right facilities to create their own energy. They're not oil independent, and so that's a problem. You're going to see, and so how do they deal with that problem? Just print more money. So the problems in Europe are far greater than France can help with, and so you're going to see though that continue devalue of currencies around the world, and they just dump into the dollar, and they're going to be looking for things to do, and it would help them, but I don't think they're going to get there in time. Personally, I just don't think they're going to get there in time. So could it be helpful? Absolutely. I mean, it's the world's hardest money. If you stop, pull back, and think about it, the only difference is that the U.S. dollar has everybody using it and believing in it. Well, that belief will stop at some point. At some point, that will stop. I don't know when, and it'll be the last or one of the last currencies to fail. But with the rate we're going, even the Treasury itself says it's unsustainable. They put out a report and they put out a chart that showed debt to GDP rising exponentially, and they said this is unsustainable. It is actually a subtitle to the report: an unsustainable fiscal path. They know it. Are they going to stop it? No. Now we could have something of a productivity miracle in the form of AI. And I don't think that's a 2 to 5 year proposition, but it's more like a 10 or 5 to 10 year or longer proposition, where you have tremendous productivity per citizen that is created by AI assistance. I do believe that could happen, and that will help. But it doesn't help the Fed. It doesn't help the Treasury, because that's a tremendously deflationary pressure. So it's going to be interesting if you read Jeff Booth's The Price of Tomorrow, his book. You'll understand that you have this deflationary pressure of technology that's coming up against this inflationary need of central banks, and they're going to collide, and that could create that. The optimal thing to do ahead of that would be to add Bitcoin to central bank balance sheets before that happens. And that'll enable the central banks to weather that deflationary storm.
Well, look, James, really enjoyed our conversation. Very well articulated. Where can folks go to learn more about your writings and thoughts?
Yeah. The Bitcoin Opportunity Fund is this first fund is closed. It's for, just to make it clear, and I have to say it's the SEC. It's for accredited investors. But if you're an accredited investor and you're interested in that type of thing, we invest in the Bitcoin ecosystem in startup companies and in the public markets, and it's a Bitcoin standard fund. If you're interested in that, you can send an email to james@bitcoinopportunity.fund or general@bitcoinopportunity.fund and or just go to the website and attest that you're accredited and put your name in. It's just bitcoinopportunity.fund. That's the first thing. And we'll likely have another fund in the near future as opportunities arise. And we're seeing more and more opportunity. And when that's warranted, which we believe will be soon, we'll open up another fund. And then the second thing is I write the Informationist, a newsletter every week that simplifies financial topics like we've done today in short form, and it comes out every Sunday. And there's a free version and a premium version, but you can just find that at jameslavish.com. And then of course I'm always on Twitter at James Lavish on Twitter,
Awesome.
talking about all these things. So
cool. Awesome. Well, thanks again. That was great.
Yeah. Thank you for having me, and we'll look forward to the next time.
Absolutely. There's over 500 protocols building on Polkadot, and one of them is called Polymech. Polymech is a decentralized, community-driven funding protocol on Polkadot, enabling regulatory compliant and transparent fundraising of Web3. Polymech ensures compliance with a novel KYC AML process, facilitating a trustless and automated funding process from fundraising to token distribution. By removing intermediaries, Polymech offers accessible, inclusive, and transparent funding opportunities for all participants. Powered by Polkadot, Polymech is redefining fundraising in the crypto space. Explore how to become a Polkadot VC at polymech.org.